There is a lie that has been told so many times with such confidence and such authority that it has become the foundation of our entire financial reality. It is a lie that flickers on millions of screens around the world, 24 hours a day, 7 days a week. It is the lie that the price you see on your monitor is the value of the asset you hold in your hand. We are living through a moment in history where this lie is being exposed, not by a whistleblower or a government report, but by the raw, undeniable force of the market itself. We are standing at the edge of a precipice, looking down into a chasm that has opened up between two worlds. On one side is the world of the West, the world of paper contracts, of high-frequency trading algorithms, of leverage, and of debt. On the other side is the world of the East, the world of physical atoms, of strategic stockpiles, of manufacturing, and of savings. For decades, these two worlds have been held together by a fragile bridge of trust. We trusted that the paper contract could be exchanged for the physical metal. We trusted that the price in London was the price in Shanghai. We trusted that the market was a single unified organism. But in the early hours of this morning, under the cover of darkness, while most of the Western world was sleeping, that bridge began to crack. We are witnessing a phenomenon that terrifies central bankers and delights true investors. We are witnessing the great disconnect. The price of silver and gold in the paper markets of the West has been smashed down, manipulated by mechanics and margin calls, driven by a desperate need to maintain the illusion of fiat stability. But in the physical markets of the East, and indeed in the physical markets of Main Street everywhere, the price is refusing to follow the script. The price is revolting. We are seeing a spread open up between the spot price and the street price that is so wide, so persistent, and so undeniable that it threatens to break the entire mechanism of price discovery. This is not just a trading anomaly. This is not just an arbitrage opportunity. This is a war. It is a war for the truth. And the battlefield is the spread. To understand why this matters and why what happens next could change everything for your portfolio and your future, we have to go deep into the plumbing of the global financial system. We have to look at what happens when an irresistible force meets an immovable object. The irresistible force is the infinite printing press of the paper market, which can create supply out of thin air to suppress prices. The immovable object is the finite reality of the physical world, where ounces cannot be printed and where the demand for silver is becoming a matter of national security and industrial survival. When you look at the events of the last few days, you might feel fear. You might see the red candles and feel that punch in the gut that comes from watching your net worth drop. But I want you to look closer. I want you to look past the red paint and see the structure underneath. Because what is happening is that the paper market is screaming sell, while the physical market is screaming buy. And when these two signals diverge, reality always wins. It might take time, it might be messy, but physics always defeats finance in the end. The spread we are seeing, the difference between the price of silver in Shanghai and the price of silver in New York, is the most important data point in the world right now. In a functioning, efficient market, this spread should not exist. If silver is cheaper in New York, traders should buy it there and sell it in Shanghai until the prices equalize. That is how arbitrage works. It is the immune system of the market, keeping prices in line. But the spread is not closing. It is persisting. Why? Because the immune system is broken. The friction in the system has become too great. The ability to move physical metal from the West to the East fast enough to satisfy the demand is collapsing. The vaults in the West are being drained, but they cannot be drained fast enough to lower the price in the East. This means that the price of silver is no longer a singular truth. It is a matter of geography. It is a matter of form. If you are holding a paper contract in New York, you own a promise. If you are holding a physical bar in Shanghai, you own wealth. The market is starting to price these two things differently. The promise is becoming worthless, while the wealth is becoming priceless. This bifurcation is the nightmare scenario for the bullion banks. Their entire business model depends on the illusion that paper and physical are interchangeable. Once the world realizes that they are not, once the premium for physical metal becomes permanent, the power to set the price shifts from the paper exchanges to the physical possessors. We are watching a transfer of power in real time. For 50 years, the price of gold and silver has been set in London and New York. It has been set by men in suits trading leverage. But now, the price is beginning to be set by the people who actually use the metal, by the solar panel manufacturers in China, by the electronics giants in Korea, by the savers in India, by the central banks in the global south. They are voting with their wallets. And their vote is, we don't care what the COMEX says, we are willing to pay more. This willingness to pay a premium is not an act of charity. It is an act of desperation and clarity. They understand something that the Western algorithm does not. They understand that certainty has a price. When you pay a premium for physical silver, you are not being ripped off. You are paying for the certainty of possession. You are paying to remove the counterparty risk. You are paying to exit the matrix. In a world where banks are failing, where governments are seizing assets, where currencies are being debased, the value of no counterparty risk is exploding. The premium is simply the market pricing and the risk of the system collapsing. Think about the local coin shop owner. When the spot price drops $2, but he raises his price by $2, he is sending you a message. He is telling you, I cannot replace this inventory at the paper price. If I sell this ounce to you for the spot price, I am losing money, because the wholesaler will not sell to me at that price. The dealer is the canary in the coal mine. He lives in the real world of supply chains and logistics. He knows when the metal is tight. And right now, he is hoarding his inventory or charging a massive premium because he knows that the paper price is a lie. He would rather keep the metal on his shelf than trade it for paper dollars that are losing value, unless you pay him enough to make it worth his risk. This is the psychology of the physical holder. It is fundamentally different from the psychology of the paper trader. The paper trader rents the asset. He wants to flip it for a profit in fiat currency. The physical holder owns the asset. He views the asset as the money, and the fiat currency as the volatile trading token. When the price of the token drops, the physical holder doesn't panic. He sees a discount. He sees an opportunity to exchange more fake money for real money. This sticky demand creates a floor under the market that the paper shorts cannot break. They can push the paper price to zero, but they cannot make the physical holders sell. In fact, the lower they push the paper price, the faster the physical metal disappears from the market. This dynamic creates a liquidity trap for the shorts. They are shorting a market where the inventory is vanishing. They are playing a game of musical chairs, and every time the music stops, there are fewer chairs. Eventually the music will stop, and there will be no chairs left. That is the moment of the snap, the moment when the paper market breaks, the moment when a major industrial user demands delivery and is told no, the moment when the price gaps up to meet the physical reality. We need to discuss the friction that prevents the arbitrage from closing the gap. Why can't we just fly silver to China and pocket the difference? Because moving physical metal is hard. It is heavy. It requires insurance. It requires secure transport. It faces customs delays. It faces capital controls. Governments are starting to realize that silver is a strategic asset. They are putting up barriers to export. They want to keep the metal within their borders. This resource nationalism adds friction to the market. It breaks the efficiency of the global trade. It means that regional shortages can develop and persist. We could see a situation where silver is $25 in New York and $40 in Shanghai, and the gap never closes. It just widens until the New York market runs dry. This is the balkanization of the gold and silver market. We are moving from a globalized, unified market to a fragmented, regional market. In a fragmented market, the price is local, and the local price is determined by local demand. In the East, the demand is voracious. In the West, the demand is awakening. This competition for ounces will drive the price higher, but it will be a messy, volatile rise. It won't be a straight line. It will be a series of dislocations and shocks. The cultural difference between East and West is the engine driving this train. In the West, we have been conditioned to believe that money is debt. We believe that savings should be in the bank. We believe that stocks always go up. We have forgotten the lessons of history. We have forgotten what happens when a currency dies. But in the East, they remember. They remember the hyperinflation. They remember the currency seizures. They remember the wars. Their cultural memory tells them that when the storm comes, you need gold and silver. You need assets that are tangible. This cultural wisdom is what drives the premium. They are buying insurance while we are day trading. The narrative of demand destruction is a myth that the West tells itself to sleep at night. They say that if the price goes up, people will buy less. But in the case of silver, high prices are a signal of value. They validate the asset. When silver rises, the East buys more, not less. It is a Veblen good. The higher the price, the more desirable it becomes. And on the industrial side, the demand is inelastic. A missile guidance system needs silver. A solar panel needs silver. The cost of the silver is a fraction of the total cost of the product. The manufacturer will pay whatever is necessary to keep the production line running. They are not price sensitive. They are supply sensitive. Their fear is not paying too much. Their fear is having none. This brings us to the most dangerous concept for the paper market, the loss of confidence. The entire futures market is built on confidence. confidence that the contract will be honored, confidence that the price is fair, confidence that the market is liquid. But what happens when that confidence evaporates? What happens when a major player looks at the spread and says, the COMEX price is fake, I'm taking my business elsewhere? We are seeing the early signs of this exodus. Large family offices and sovereign wealth funds are beginning to bypass the exchanges. They are going directly to the miners. They are going directly to the refiners. They are doing off-market deals. They are securing their supply chains in the dark. This drains liquidity from the public market. It makes the public price even less representative of reality. It turns the stock market and the futures market into a sideshow, while the real business happens behind closed doors. When the volume leaves the exchange, the volatility on the exchange explodes. We saw this over the weekend. A market with no depth is easily pushed around, but a market with no depth is also easily squeezed. The shorts are playing in a sandbox that is getting smaller and smaller. They are trapped in a cage with a tiger that is waking up. The tiger is the physical shortage. The media will try to gaslight you. They will tell you that the drop in price is due to a strong dollar or weak industrial data or the phases of the moon. They will tell you anything to keep you from looking at the spread. They want you to sell. They need you to sell. Your silver is the only liquidity left. If you hold, they starve. If you sell, they feast. It is a zero-sum game. The psychological warfare is intense. They use volatility to break your spirit. They want you to feel stupid for holding a rock. They want you to feel isolated. But look at the data. Look at the premiums. Look at the import numbers from China and India. You are not alone. You are standing with the smart money of the world. You are standing with the entities that are preparing for the next century, not the next quarter. We must also consider the role of the central banks. They are buying gold at record rates. Why? Because they know the dollar system is ending. They are preparing for a reset. And while they talk down gold and silver in public, they are hoarding it in private. They are the ultimate hypocrites. Do not listen to what they say. Watch what they do. And what they are doing is buying physical metal and repatriating it to their own vaults. They are taking possession. They are paying the premium. The scenario that changes everything is the force majeure. This is the legal clause that allows an exchange to settle a contract in cash instead of metal because of extraordinary circumstances. If the COMEX declares force majeure, it is an admission of default. It means they don't have the silver. At that moment, the paper price goes to zero, and the physical price goes to infinity. Or rather, the physical price becomes no offer. You won't be able to buy it at any price. It will be unobtainium. This is why the spread matters. It is the tremor before the earthquake. It is the warning sign that the fault line is slipping. If the spread continues to widen, it means the pressure is building. It means the dam is about to burst. You want to be on high ground when that happens. You want to be holding the physical metal, not the paper promise. The repricing of silver will not be a polite affair. It will be violent. It will destroy wealth for those on the wrong side of the trade and create wealth for those on the right side. It will be a transfer of energy from the fake economy to the real economy. It is the inevitable correction of decades of manipulation. We are watching the end of an era, the era of financialization, the era where we thought we could print our way to prosperity. That era is dying. The new era is the era of tangible assets, the era of resource scarcity, the era where he who holds the gold and silver makes the rules. China understands this, Russia understands this, the global south understands this, the West is in denial. But denial is not a strategy. Reality is coming for the West, and it is coming in the form of a silver shortage. So what happens next? If the spread persists, we will see the drain accelerate. We will see more metal leave London and New York. We will see inventories hit critical lows. Then we will see the panic, not the panic of selling, but the panic of buying. The industrial panic, the panic of the CEO who realizes he can't build his product. This buying will not care about the chart. It will clear the market. This is the moment you are stacking for. This is the reason you endure the volatility. You are waiting for the moment when the paper lie collapses and the physical truth is revealed. That moment is getting closer. The spread is the countdown clock. Do not let the short-term price action blind you to the long-term structural shift. The game has changed. The rules have changed. The location of the game has changed. It has moved from the screen to the street, from the west to the east, from the fake to the real. You have a choice. You can believe the screen or you can believe the street. You can believe the lie or you can believe your eyes. The premiums are real. The shortage is real. The demand is real. Hold the line. The volatility is the storm, but silver is the anchor. Do not cut your anchor line in the middle of a hurricane. The great metals crash was a stress test. The system failed the test. The spread proves it. Now we wait for the consequences. The consequences will be higher prices, tighter supply, and a rush for the exits of the paper market. Be ready, be positioned, be stoic. The market is trying to shake you out because it needs your silver. Do not give it to them. The future belongs to the physical. The future belongs to the patient. The future belongs to you if you have the courage to hold on. Think about the implications of a broken pricing mechanism. If the world cannot rely on the London fix or the COMEX spot price, how do we price silver? We will price it peer-to-peer. We will price it based on regional availability. We will price it in other currencies. This is the decentralization of money returning to its roots. Silver is the people's money. It doesn't need a central bank. It doesn't need a futures exchange. It just needs two people who agree on its value. And right now, the people in the East are agreeing that its value is much higher than the people in the West think. Who is right? The side that is producing the goods, accumulating the reserves and growing their economy, or the side that is drowning in debt, deindustrializing and printing money? I know which side I am betting on. The spread is also a reflection of the energy return on investment. It takes energy to mine silver. Energy is getting more expensive. Therefore, silver must get more expensive. The paper market can ignore energy costs for a while, but eventually, the miner has to pay the bill. If the price stays below the cost of production, the mines shut down. Supply crashes. Price explodes. It is a self-correcting mechanism. The slam in price is sowing the seeds of the next super spike. We are also seeing the return of Gresham's law. Bad money drives out good. The bad money, fiat paper contracts, is flooding the system. The good money, physical silver, is going into hiding. It is going into private vaults. It is going into strong hands. It is disappearing from circulation. When the good money disappears, the bad money becomes worthless. This is the cycle of currency collapse. We are watching it play out in slow motion, and then all at once. The certainty tax that John A.G. talks about is a brilliant concept. You are taxing yourself to ensure survival. You are paying a premium to guarantee that you have a seat on the lifeboat. When the ship sinks, no one cares that they paid a little extra for the lifeboat ticket. They are just glad they aren't swimming. The spread is your signal that the ship is taking on water. The spread is the alarm. Do not hit the snooze button. As we move forward into this week and the next, watch the premiums. If they stay high, the bull market is alive and well, disguised as a bear. If the premiums collapse, then maybe the paper price was right. But history and logic suggest the premiums will stay. The physical market is too tight. The demand is too strong. You are witnessing a historic pivot point, the end of the paper dynasty, the beginning of the physical renaissance. It is a messy birth, but the baby is real. Stay focused on the physical. Ignore the paper noise. The spread is the truth. Follow the truth. The next that changes everything is the decoupling. The moment when silver trades like a strategic asset and not like a tech stock. That moment is here. It is happening in the spread. Don't miss it. Don't sell it. Stack it. The war is on, and you have the winning weapon in your safe. Keep it there.